Apple is worth $4.5 trillion. Yet while Microsoft, Google and Meta are spending hundreds of billions on AI, Apple is barely spending anything. Apple's entire capital expenditure last year was just $12.7 billion. So here's the question. Is Apple falling behind in AI, or does it know something everyone else doesn't? Morningstar rates Apple a wide moat, the highest possible rating, built on 3 sources: switching costs, intangible assets and a network effect. The iPhone is the linchpin, but Apple's real moat isn't the hardware, it's the ecosystem locked around it. Every additional Apple device a customer owns raises the cost of leaving. Switching doesn't just mean buying a new phone, it means losing your message history, your health data, your seamless cross-device workflow, and starting over. The intangible asset moat comes from Apple's chip design. Its A-series and M-series chips are custom built for Apple's own hardware and software. No competitor can replicate this integration by buying off-the-shelf components. And the network effect is reinforced by over 1 billion active iPhone users, attracting the best developers, which in turn attracts more users. The result? Gross margins of 49.3%, a record for a company that makes physical hardware. That is the moat in action. The one real risk worth flagging is regulatory pressure. The EU has already forced Apple to open third-party app stores and adopt open messaging standards. If antitrust rulings chip away further at the App Store model, services revenue, which is Apple's highest margin segment, faces headwinds. Every data point in this video came from FISCAL.AI, the platform I use for every stock analysis on this channel. Link in the description for 15% off. Returns on capital tell us how efficiently management converts invested dollars into real profit. Apple's return on invested capital is 48.2%, the highest in its peer group. And here's the key insight. While Apple's returns are climbing, every single peer is seeing return on invested capital compress. The reason is the same across the board: AI capital expenditures. The more Microsoft, Alphabet and Meta spend on data centers and infrastructure, the harder it becomes to maintain high returns. Apple spending a fraction of what they are is structurally insulated from that pressure, at least for now. On return on equity, Apple's in a different category entirely at 171.4%. I want to be transparent here, this number is significantly inflated by Apple's aggressive share buyback program. Last year, Apple repurchased $96.7 billion in shares against a total equity base of just $73.7 billion. That mathematical reality makes a direct return on equity comparison to peers difficult. But peers are all substantially lower. Alphabet at 35.7%, Microsoft at 33.3% and Meta at 30.2%. The returns picture is strong and structurally protected by low capital expenditures. Now let's see whether the growth justifies the valuation. Growth is the engine that drives long-term value creation. And for Apple, the numbers are solid but not spectacular. Over the last decade, revenue has grown at a compounded annual growth rate of 7.6% and net income at 10.5%. Earnings per share has grown faster at 15.3% annually, again amplified by the buyback program, reducing the share count year after year. Now here's the honest comparison. Every major peer is growing earnings per share faster than Apple right now. Alphabet at 25.6%, Meta at 23.6% and Microsoft at 20.4%. Apple's projected earnings per share CAGR through 2028 is 13%, reaching $10.7 per share. Solid, but not the kind of explosive growth that typically justifies a premium valuation. Now what could change this? Apple may be entering its strongest iPhone upgrade cycle since 2021, and the reason has nothing to do with AI. Many consumers have held onto their phones longer than usual, creating a backlog of potential upgrades. Revenue grew 17% year over year in the most recent quarter, and iPhone revenue alone rose 22%. If that refresh cycle continues and China demand keeps recovering, Apple's growth could surprise investors over the next few years. But the longer-term question is whether Apple's deliberate restraint on AI capital expenditures will prove to be discipline or delay. We'll return to that question in the valuation section. First, let's see just how strong Apple's financial position really is. Financial strength is our sleep at night factor. Apple holds $54.7 billion in cash against $98.7 billion in total debt, so there is some leverage here. But the context matters. Free cash flow is $98.8 billion, so Apple can cover its entire debt load with just 1 year of free cash flow. That gives a free cash flow to total debt ratio of 100.1%. Well above the 10% minimum threshold. Apple's financial strength is outstanding. The leverage is deliberate, not distressed. It reflects a company that borrows cheaply to fund buybacks while generating cash at a scale very few businesses in history have matched. Even the greatest business can be a poor investment if you overpay. And right now, that's the central question facing Apple investors. Apple's forward price to earnings is 34.1. In historical context, the decade low was 12.1, the median was 25.8, and the maximum was 36.8. Apple is currently trading near its all-time historical valuation peak. That alone should give long-term investors pause. Against peers, the picture is even more striking. Alphabet trades at 29.8 times forward earnings, Microsoft at 23.3, Meta at 19.1. Apple at 34.1 carries the highest valuation in the peer group, despite delivering the lowest earnings per share growth among them. Now on to the price to earnings growth ratio, because PE alone ignores growth. Apple's long-term earnings per share growth estimate is 11.8%. At a forward PE of 34.1, that gives a PEG ratio of roughly 2.9. Below 1 points to undervaluation, between 1 and 1.5 is fair for quality companies, and above 1.5 is expensive. At 2.9, Apple is the most expensive stock in this peer group on a PEG basis by a wide margin. Compare this to Alphabet at 1.9, Microsoft at 1.45, fair for quality, and Meta at 0.9, technically undervalued on this metric. But here's the twist. Everything in this analysis comes down to one question. Is Apple being disciplined, or is Apple underinvesting in the biggest technology shift of the last decade? By 2028, analyst estimates show Apple's capital expenditures at just $14.5 billion. Compare that to Microsoft at $175.9 billion, Alphabet at $242.9 billion, and Meta at $169.1 billion. If that spending drives transformational growth, Apple's position weakens. If it doesn't, Apple's superior capital efficiency and relentless buybacks could make today's valuation look far more reasonable in hindsight. The bull case is that Apple never needed to win the AI race. The bear case is that it does. Apple trades near its historical valuation peak, grows slower than every major peer, and carries a PEG ratio of 2.9. If Microsoft's, Alphabet's, and Meta's AI investments begin creating products consumers genuinely cannot live without, Apple's moat could face its most serious test since the iPhone launched. Now let's bring it all together through our 5 key factors. Apple has a wide moat, the highest possible rating, built on switching costs, in-house chip design, and a network effect between over 1 billion active users and the world's best developers. Returns on capital are exceptional, 48.2% return on invested capital, the highest in its peer group. Growth is steady but modest, 13% projected earnings per share CAGR through 2028, the slowest among peers. Financial strength is outstanding, $98.8 billion in free cash flow and a buyback machine that has compounded per share value for more than a decade. But at a forward PE of 34.1 and a PEG ratio of 2.9, Apple is the most expensive stock in this peer group relative to its growth. Apple may be the most disciplined capital allocator in technology. While its peers are spending hundreds of billions on AI infrastructure, Apple is spending a fraction of that amount and generating some of the strongest returns in the industry. Which brings us back to the question we started with. Is Apple falling behind in AI? Or does it know something everyone else doesn't? Let me know in the comments, and if you enjoyed this analysis, like this video and subscribe.